Thanks for checking us out this week on the fastest 4 minutes in finance. I'm Scott Inman. John Shrewsbury and I were on the morning show on 103.7 The Buzz this week, and a question came in from a listener. He asked if he should buy puts or calls on Amazon stock. Now, with all due respect, he is asking the wrong question. If you think about this question, he's actually asking and trying to predict whether Amazon stock will go up or go down over a short period of time. That's a gamble. Now, it might be an educated gamble, but so is betting on a horse race. Data released this week shows that the U.S. economy is on a highly unpredictable path in 2023. GDP for the first quarter of the year came in at 1.1%. That's a big drop from 2.6% in the last quarter of 2022, and a disappointment from the estimated 2% that was expected. Now, GDP stands for Gross Domestic Product and is an estimate of the value of all goods and services produced and sold in the U.S. Two chief components of that number were pulling in opposite directions. Business equipment fell at a 7.3% rate, showing businesses are preparing for an economic slowdown. However, personal spending was still up 2.5% for the quarter. There was also some suggestion that inflation is not completely settled on a downward trend either. PCE, which stands for Personal Consumption Expenditures, rose 4.2% in Q1. That was up from 3.7% the previous quarter. Claims for jobless benefits were down in the latest report, but at the same time, the unemployed are having a harder time finding jobs. The data strongly shows the economy is slowing down and may very well be headed for a recession. The Federal Reserve will meet on May 3rd and may or may not raise interest rates again. On one hand, they see that inflation has cooled, but still may not be settling into a path back to 2%. On the other hand, business spending and job markets are clearly drifting toward recession. After the data this week, markets are pricing in an 83% chance of a quarter-point hike. That's up from 72% just the day before the data was released. So you would think that the markets were rattled by the weak economic data. Not immediately. The S&P 500 index rose more than a full percentage point on the day the GDP and PCE numbers were released. And LPL research reminds us that even if we do go into a recession, the stock market may actually go up during it. So the bottom line here is markets don't always make sense in the short term. So back to our radio listener. If he wants to play with puts and calls using money he would otherwise take to the horse track, that's fine. But gambling with money you need for retirement like that doesn't make any more sense than bad news driving the market up on any given day. Believing in the long-term success of the stock market does, however, make sense. Since 1928, the S&P 500 was positive 75% of the time over a one-year period. The longer you stretch that time period, the better that percentage gets. It's been positive 89% of the time over a 5-year period, 94% of the time over a 10-year period, and 100% of the time over a 20-year period. Belief in the long-term success of the stock market is vital to your investment strategy, but betting on the short-term direction of the stock market is a recipe for disaster. Thanks for watching.